Hey guys, Whitney here. Welcome to Passive Investing Simple. Or excuse me, I can't even name my own podcast today. Passive Investing Made Simple. This is a live masterclass that we do every Tuesday, and I'm super excited to have you guys here. We're going to give it just a couple minutes for people to file in the room. If you have a question at any point in time during today's broadcast, make sure to go down to the bottom bar on your Zoom controllers and find the Q&A box. I'll be moderating our conversation. I anticipate that we are going to have a ton of questions. We will do our best. We're going to get through some broad information during the presentation. For those who are joining with us live, you're definitely going to be able to participate in after our recording in the after party, and we are going to do our best to get through as many questions as possible. If not, we have a ton of resources that we can point you to, and people ready and standing by to answer your questions if they're more kind of like direct and personal. All right. But if this is your first time joining us, welcome. This is a live class where we actually are trying to help you learn all about the different facets of passive investing so you can go into your first or next investment with confidence. So if you are not already registered for future masterclasses, be sure to go to passiveinvestingwithwhitney.com. You can see you'll be registered, or you can get the notifications about registering for future masterclasses. You can also see our open deals, as well as hop on my calendar and we can talk all things real estate. All right. To kick off today's episode, I am super excited to bring on Brandon Walsh and Nick Gonzaga of Rocket Dollar. Welcome, Brandon and Nick. Why don't you guys go ahead and kick us off and tell us a little bit about yourself and how you got started in the self-directed IRA environment?
Sure.
Yeah, absolutely. Go ahead, Brandon. I'll go after you.
So thank you, Whitney, for bringing us on today. I used to be a financial advisor in the 401k space before joining Rocket Dollar. And after talking to every HR person in the entire city of Chicago, unfortunately, 401ks, people don't like to think about them. They're usually thinking about their health insurance. But I really had a desire to stay in finance and fintech, as so much things are modernizing this space. So I started talking with our CEO, Henry Yoshida, and he said, "Hey, I have a company that's doing self-directed IRAs." I said, "What's that? I don't even know what that is." And as I got to talking to him, it's an IRA that can invest in alternative investments like real estate. So that's why it's exciting to be here today. That was 4 years ago that I was talking to Henry. We've grown to, be a much bigger company today. We have, over 25 employees, close to $900 million in assets, and we have over thousands of customers. So I do a lot of our business operations and sales and partnerships here. If you've ever been in a Rocket Dollar webinar, you might have seen me. You've seen my face for the first time. And then I work with Nick Gonzaga on our team. Nick, take it away.
Great. Thanks, Brandon. I lean a lot on Brendan. He's been here probably the longest on our sales team. So whenever there's some crazy crypto question that comes up, we always bring in the guru, and that's Brendan. So before I was with Rocket Dollar, I was with a company that managed large 401k plans. So I was a retirement consultant on those plans. Meet with the human resources team, C-suite, just to let them know what's going on with the account, what can be better, what can be different. But before that, I actually knew Henry from our days at Merrill Lynch about, I want to say 12, 13 years ago. So that's how we wound up knowing each other. And he's always had his hands in a couple of things, in a few different projects. And after he sold his Honest Dollar, we were like, whoa, Henry's actually pretty legit, huh? Okay. And so that was his last foray into doing his startup fintech. And now he's doing Rocket Dollar. And we had heard some rumblings about Henry's new projects. So a lot of us that had known Henry were kind of like, oh, what's he going to do with this one? Well, back in October, he pulled me in and was like, hey, I want you to come join me. And I was a little skeptical because I didn't really understand all the ins and outs of private placement investments and, this, that, and the inner workings. But I joined up, and from what I've been learning so far, I mean, it's just like drinking from a fire hose. There's new stuff happening every day. very difficult to keep up, but it's been great.
Yeah,
Awesome. Well, and that is what it's like for our passive investors here, is drinking from a fire hose, learning about all the ins and outs on how to set their goals, how to vet operators, vet markets, vet deals. And then you start getting into all the different ways that you can utilize not only your personal cash to invest in passive investments, but like now you can use your retirement funds.
Mhm.
So let's start like getting into this. I mean, Brandon, you mentioned that, what Rocket Dollar allows you to do is move your monies into self-directed environment and invest in alternative assets. I mean, most people live in a house or have a house over their head. So it just blows my mind that, real estate is considered an alternative asset. But before we dive down that rabbit hole, like what are the benefits of moving your funds into a self-directed IRA that all passive investors should know about?
Sure. Well, oh, sorry, you asked Brendan. Go ahead.
Nick, I want you to take this one. Go through some of those pros and cons that we talked about.
Yeah, okay, absolutely. So, I mean, right off the bat, it's the fact that you're going to have tax deferral, and people get that confused with what's tax-free. Well, it's not necessarily tax-free. It just means you're not going to be taxed on it whenever the transaction happens inside the investment vehicle, right? So, like if I'm buying and selling stocks in my IRA, I can expect to have no capital gains tax, and really nothing is going to be taxable until I say, okay, I'm going to take this money out because I need a new air conditioner for my house. Well, that withdrawal is going to be taxed, right? Whereas if you have the regular retail type account where you're doing the trades, if you have a gain, you're going to get taxed on that, and there's going to be a long-term or short-term tax consequence, depending on how long you hold it, right? So a lot of the different rules with retirement accounts, I mean, you look at the traditional IRA versus the Roth, and a lot of people still aren't real clear on those concepts. In general, Roth is great. When you retire and if you had it at least 5 years, it's going to be tax-free. That means when you take earnings out, anything that you put in that account, that's tax-free. In terms of cons, well, some of the cons are going to be something like, oh, I can't write down my losses against, some of my gains to pair that up. Okay, well, that's probably a con for that particular year. Is it going to be a con for the year after or 5 years down the road? Maybe not. Maybe you'd rather pay less taxes and not have to deal with it year over year. But that's going to be completely up to an investor's decision. But one of the main, I guess, aspects of investing in an IRA, like what Rocket Dollar offers, is you really have to be aware of the investment that you're doing, who you're doing it with. So when you make an investment, it has to be a passive investment. You can't have any kind of tinkering going on or work on the property. So in essence, you have to be at least arm's length away. That's sort of the rule of thumb that the IRS uses. If you wind up getting too close to management, then things start getting a little bit muddled and you wind up having to explain far too much to a regulator, right?
And yeah, so to really tie it together here, you are basically the biggest immediate advantage is you forgo that capital gains tax. You're deferring your taxes all the way to retirement, where hopefully, that's up in your late 50s or 60s or 70s or 80s. And the one big thing you lose in real estate is you lose depreciation or that ability for a 1031 exchange. So when some people analyze an investment that they're going to do through a self-directed IRA, they'll try and look at really capital gain heavy type of properties or investments. And if they see one that's really tax efficient for depreciation or a 1031, or if they might even want to be closely associated with that property in the future, maybe buy a piece of it, live in it, put it close to their business, they'll do that through a taxable account.
So just to clarify one thing, are you saying if somebody invests in a syndication, passive syndication, that they cannot do a 1031 exchange, or they just don't get the benefits of the 1031 exchange?
Yeah, you cannot do a 1031 if you do it through an IRA investment. So if you invested with your IRA and then personally, you could do a 1031 on that taxable cash investment. Your IRA side, it is impossible to do a 1031. And the reason why is the investment is really already tax deferred and tax advantaged. So you cannot go and add in a 1031 onto that investment.
Oh, very interesting. Yeah, I have never heard that before, because a lot of our investors will stay in and roll their funds into the next exchange. They're not pulling them out and doing their own 1031 exchange. So I just want to make sure we're, giving people the right information on that.
To keep the tax advantage going in an IRA investment, what will happen is, you'll invest into property A. Let's say it's very successful, and there's a big gain in it, and you'll sell it out to cash. You are totally protected from any tax in that investment. So no tax gain will hit you at all. You see property B also looks pretty good coming up in the deal next year. You move all of the gains and that money into property B. So the 1031 really is not involved because the IRA is already taking care of your great tax protections. Now, if you want to do a 1031 on the side somewhere else, without Rocket Dollar, you can definitely do that. It's just when you're doing it within an IRA, you do have to kind of, forget about the 1031 in that aspect.
Right. And I just want to piggyback off that real quick. There's no time frame, right? When the transaction occurs and then you want to invest into another investment, there's no start and stop when you decide to do that. It's going to be up to you when you find another property.
Yeah. So a lot of, to use the stock
pigeonhole about that 45 days.
Yeah,
right.
and to use a stock example, this sometimes helps people grasp their mind around it. If you had a 401k and it was invested in a bunch of mutual funds, and then you sold out to cash because you were worried about the market conditions, then you left that for 5-6 years in cash. Maybe not the smartest, decision to stay out that long, but you would not pay any taxes on the stocks when you sold it, and you're not paying any taxes when you bought and sold stuff again in that 401k. So inside of an IRA, you're kind of perpetually protected from those taxes until you decide, hey, I want to draw this money out. And usually investors are not doing that until they're in a ripe retirement age, in their 60s, 70s, or 80s.
All right, I want to stay down this, keep going down this tax rabbit hole just a little bit, but then I want to pull it back out and define, traditional versus Roth, and really kind of, set the person who has no idea about this world on the right path. But and this is a question, I know I'm going to get it. What about UBIT tax? Can you guys define that, and how does that come into play, like with real estate investment?
Oh boy, so that's a doozy for early on in the webinar, but
we can stick a pin in it.
We're jumping forward a little bit, but
yeah,
it's all right.
So with UBIT, it's good for investors to be aware of it. I'd say not afraid of it in a self-directed IRA. For an investor who's not familiar, or who's maybe only Googled that word once or twice and goes, what is this? Basically, if you're in a traditional IRA or Roth IRA and you have a very successful real estate investment, it is usually tax-free, usually completely tax-free, and everyone's having a great time, and they think this is an amazing investment, and then they talk to their CPA and they're like, the CPA is like, did you factor in the UBIT? I think this investment is UBIT. And all of a sudden that's the scary moment where self-directed IRA investor goes, wait, I thought this was entirely tax-free. Did I get a gotcha? Was I not told about this? And UBIT is unrealized business income tax. It exists because when the government made IRAs and they made tax-free charity statuses, they said there was a few people that they tried to put certain assets or investments and they tried to shove it into charities because they figured out they could pay no taxes on it. These investors who were also not really trying to follow the spirit of the rules of the law also figured, hey, I could shove my really tax-heavy business. Why don't I just shove that entire thing in an IRA? And then, oh, bingo, I cheated the IRS. I'm good. I don't have to pay anything ever again in my life. So the IRS, talked to the government. They said, hey, we like that you created IRAs. They're great for people to retire on. We like that you created a nonprofit charity status. That's great for foundations to build, do great public work. But we need to put a few kind of gotchas to make sure people don't hide whole businesses inside of an IRA or a charity. So they created UBIT tax, unrealized business income tax, saying, hey, there are some certain areas where we still have to pull some taxes from these types of investments. They tend to hit active investors more than passive investors. And they tend to hit debt-heavy investors more so than equity investors. So if your investment issuer has kind of set up things correctly, it should hopefully minimize your UBIT risk, where when you go invest into a real estate deal with a self-directed IRA, it could be good to ask the deal runner, hey, do you know if there could be any UBIT risk to this? And they might know, they might honestly not know. It's not their fault. It's usually a qualified CPA who should answer that question. So at Rocket Dollar, we have a couple CPA resources that we can refer people to. And think of these as CPA specialists. They're not doing your standard tax return, but if you do a couple real estate investments in a self-directed IRA, it can be good to check with them at the beginning of the investment, just for a quick temperature check. And then to file your tax form called a 990T, if you need to do a specialized tax form. So to kind of wrap all this up, not every self-directed IRA investment has UBIT. Most passive investors tend to kind of escape it and be free of it. However, you do want to be aware of it as you jump into this. And you always want to check ahead of time, hey, could there be any UBIT impact on here? Because you don't want to be blindsided by it. And if there is some, you can typically write that tax down through business and operating expenses that are coming through the real estate investment. So if you're ever unsure about UBIT or having some trouble, we do have some content on it at Rocket Dollar. And then we do also have a couple CPA contacts that we can send. And they can do a complimentary call to kind of educate you on it, check on the investment that you're doing it, give you a quick temperature check, and then actually file for a return for you if need be.
Oh, that's fantastic. And I mean, I know when I started investing passively with my, put my monies in a self-directed IRA environment, and then I started investing, I had no idea what UBIT was. And then I kind of like what you described there. I got like, 6 months in, I'm like, whoa, UBIT? What? What is this term that I should have known?
It is a complex topic, but there's a lot of providers that frankly, they just don't talk about it at all. Or they're like, oh, you find out about it 12 months later, you like, just go to a CPA. We're not helping you, like, we're not even going to say literally anything about it. Just go to the CPA. And we find that, that frankly pisses people off because they didn't know about it. And it's some people ask like, well, if there's this UBIT tax, why would I even do an investment in an IRA? Mm-hmm. And the answer is, it's just something to be aware of, not afraid of. If you plan for it, if you strategize for it, you can usually write it down or frankly eliminate it completely. Or you can invest in a certain investment that is exempt from it. And that makes sure you're not caught, with your pants down on it. And we also offer a solo 401k as well. And, someone, who had a solo 401k, they may have been self-employed. They might have been married to someone in Congress or something, but there is a exemption from UBIT for solo 401ks. There's a lot of types of UBIT, but the kind that often hits real estate and debt, the solo 401k is never really has to pay UBIT tax in there. Mm-hmm. So if you are self-employed or your spouse is self-employed, you can always talk to us about a solo 401k. And we've really even had some very busy real estate investors. They already have kind of a self-employed side gig that they're working on, but isn't really formal. Sometimes they take the plunge and just make it a formal entity, and then they open a solo 401k at Rocket Dollar. And then those investors, they don't even sweat UBIT at all. They just said, not my problem. I got a solo 401k. I don't need to worry about that.
Mm-hmm. Well, and to wrap up, the story that I was telling about beforehand, is that, I actually found that it wasn't as impactful to my investment because the operator had actually taken a lot of those, had structured it properly. So I want to move off this topic because, again, we kind of like launched down right into like a big rabbit hole here. Let's back it up because we've mentioned traditional IRAs, we've mentioned, self-directed IRAs, we've mentioned traditional Roth, and then we threw out a solo 401k. If we can zoom back out to the self-directed IRA, which probably applies to most people listening here, what's the difference between a traditional and Roth, and how can somebody orient on which one to open? Which one's the better situation for them?
All right, Nick, take that.
Yeah, that's always going to depend. So which is better, the traditional or the Roth, I think was what the question was. Sorry, I got stuck in the Q&A chat. I'll leave that for you, Brendan. So, I mean, it's not always going to be clear cut, right? And you kind of have to run the numbers. What's it going to look like when you retire, when you're in a higher tax or a lower tax bracket versus the tax bracket you're in now? And I guess the best way to say is it depends on if you already have a Roth account, because if you don't have a Roth account, then you have to fund it. And if you're going to fund it, that means either you're limited to the $6,000 if you're under 50, but by the IRS rules. If you're over 50 or over, you get an extra $1,000 for catch up, right? That's probably not going to help you a whole lot if you're looking to purchase some commercial real estate. But that's when you're building the Roth. If you already have a Roth and you have a decent chunk of change, then you can have a better understanding of what it's going to look like when you start investing into a property that's going to give you tax-free return, right? When it's all said and done. But yeah, a lot of it depends on what tax bracket you're in. If you're in a higher tax bracket, you're going to want the write down on your deductible contributions, right? You're not going to want to pay the 35 or whatever 40% it is income tax to do the conversion from traditional to Roth.
Yeah, and if you polled clients on the phone, if you had like a lot of our questions about Roths, they're a little bit more complex because you have younger investors who automatically qualify for it. Like Nick's saying, it's easy for them to put money in. The IRS doesn't restrict them at all. You have very wealthy investors that like try and do all these strategies to get more money into Roth because they want that like long-term tax-free money, but they make a lot of sacrifices. They pay CPAs, they're converting money, and they sometimes take huge tax hits up front just to get all that money into Roth. So if you pulled the phone, everyone would be screaming about Roth all day. But if you look at our Rocket Dollar customers, we have so many more traditional IRA clients of all ages. And the reason why, it's simple. You get a nice tax deduction, and it's accessible to almost anyone, no matter what your income level is. So the Roth is good for people that are willing to work on it, talk to a CPA, kind of strategize, and they are fine with their current tax levels. If taxes are screaming at you and it's really painful to be paying that tax bill, a lot of our clients just say, hey, $6,000, it's something, it's helping, whether they're wealthy or not, it's a huge thing to bring down their taxable impact.
Right, and there's
so,
phase out limits, but we'll talk about that later.
Yes, yeah, with the Roth. Well, so talk to me like if somebody contributes to a Roth or a traditional IRA, and then they go into an investment. How's cash flow handled? How are gains handled? Do they have to go right back into the account? Is that something that somebody can actually like use for their day-to-day expenses?
So, no is the answer to. I'm just kidding. So, what happens when there's any proceeds generated from investment within the IRA? That is all supposed to flow back to the custodian, right? So back to the source of where the investment's being held. It's not necessarily meant to be an income providing investment, even though that's kind of what it's doing. But once you start taking the money out of the IRA, that's your income, right? So you're building up that account, the IRA, to take money out later. So if you're in, let's say you're in that 35 tax bracket now, well, you're not going to be in the same tax bracket when you're retired, right? Because retirees is going to be what, 20-25%, more or less, maybe lower and maybe higher, depending on what state you live in. But that's something that's going to offset that long term. So it's all going to go back to the custodian until you take money out, put it in your pocket.
All right, so let's shift a little bit. Like, how does if somebody is like, okay, I either want to start setting up a Roth or I want to, set up a traditional IRA and start funding it more aggressively so I can go into a passive investment. How does one go about doing that?
So what a lot of people don't realize is they generally already have, or they might already have some money set aside from a previous employer, right? That's kind of the bread and butter of the whole IRA market, right? I put money in my 401k 2 or 3 employees ago, never did anything with it. It's probably still over there. I haven't tracked it. That's funding for any investment you want to do within an IRA. You just do a direct transfer. And what a lot of people think is there's rules and timeframes around moving that money out, putting in your IRA. That's, I guess, a real big misunderstanding. You can take, and so depending on what the employer's plan says, if you're terminated or separated from service from a previous employer, you can almost always take that money out and move it into an IRA or a Roth IRA. So most of the time, that's going to be your main funding source. Outside of that, it's really just making contributions into the IRA. It's always going to be based off income, right? So earned income. It can't be a dividend that you receive from an investment that you want to put into your retirement account. The IRS does not allow for that. So, and then I guess funding the Roth is really, if you don't have one, you really want one, you could do what's called a conversion. And that's just taking your pre-tax money, paying taxes on it, and putting it in a Roth.
Yeah, and as Nick said, the easiest way, look for that old 401k. Just try and take stock of where all your investments are. I have trouble with it sometimes. We have trouble with it. The number one question before like someone even meets with a financial advisor is like, oh, I don't even remember where all my accounts are. So just go look at where that money is. That's the easiest way to hit is it a $40,000, $50,000 or $10,000 investment minimum, pulling from an old 401k and turning that into an IRA. And the most painless way to do that is to just send it to a traditional IRA. Most 401ks, the dollars are pre-tax and go into traditional IRAs. And you don't have to talk to Nick or I about complications and conversions. If you have been using a 401k account, it is becoming more popular now that you'll have a pre-tax or a traditional side of your 401k, and you'll also have a Roth bucket of your 401k. So what if I could like close my eyes and someone puts a 401k statement in front of me, 95% chance it's going to be 100% traditional. I'd say there's a 5% chance it's probably, 80% pre-tax dollars, which would go in a traditional IRA, and they might have like 20% of it that could go in a Roth account. So if you do have that, that would split into 2 IRAs. The pre-tax would go to the traditional side. The post-tax 401k bucket would go to the Roth side. So a lot of our investors getting started out with us, they'll say, all right, I really want to do real estate in an IRA. And they'll take stock like, what's my biggest bucket to really go after a couple good passive investments? It's usually the pre-tax side of an old 401k, and they'll take from 1 or 2 jobs. That's the most common. And we're happy if you talk with us, our sales team, we'll be happy to guide you through all these complexities. But I'm telling you, of all the people on this webinar, they probably have big 401ks in pre-tax 401ks that can go to traditional IRAs right now. The only IRA that's hard to get at is your current 401k. So if you work at a company right now, unfortunately, just the way the industry works is they don't like that money leaving the door, because when you're employed there, you contribute just a couple pennies a month to their fees. So when you currently work at the job, they like to keep it nice and locked up. Once you leave, they have no legal recourse to keep you there. You can pull all that money out right away.
Right.
So I have a couple of follow-up questions on that. So you mentioned that, moving monies from a previous 401k is probably one of the easiest ways to set up a self-directed IRA. What is is it all or none, or can you break that up if you wanted to keep, some investments with a brokerage or, some in a self-directed environment?
Yeah, that's a good question. You could piece that up however you want, honestly. And it really depends on so 401ks are governed by a plan document. In the plan document, it'll say you can do a partial or a full. Most of the time, you can do either one. It doesn't necessarily matter. Strategically speaking, there's really no purpose to have your 401k money in the employers. If you've already left, it's fine if you want to leave it there, right? Who am I to tell you what to do with it? But it's really not doing any, it's not serving a purpose for you. But you could take all that, move it to any provider that has an IRA brokerage, right? And decide what you want to do there. So once it's at the brokerage, you can say, I'm going to move half of this to Rocket Dollar, and the rest of it, I'm going to put it in a passive index fund. And that's going to be what my investment is. Now I'm going to go look at some commercial real estate. Maybe there's a car wash out there I want to be invested in. So you can move it around. And the way that the term is called a direct transfer. Rollover is mostly known, but it's widely used, but not really fully understood. When it's a direct transfer, it's not going to be a tax reportable event, and so there's no tax consequence. It just goes directly from one place to another place.
Yeah, and so basically, you can give us however much you want to put in an alternative investment. And that's usually the easiest way to get started. Is you say you have 1 or 2 investments you want to do with us, just roll only the amount of money that you want to put into that passive real estate investment to us. And if you want to do something else with that, you can transfer that elsewhere. And let's say if a year in, one of those investments finishes or closes out, you can move that out of Rocket Dollar right away. Your IRA money is really yours to move wherever you want to move it. As long as you can sell out of an investment, that's really easy to move to any IRA platform in the world, whether it's Fidelity, Vanguard, TD Ameritrade, or Rocket Dollar. Your traditional IRA money can go to any traditional IRA. Your Roth money can go to any other Roth IRA. So the average American has like 6 IRAs. Some people think you can only have 1 or 2. So a lot of people will have, a couple stocks and bonds IRAs, and then they'll have 1 self-directed IRA.
Yeah, I know for me, I have an IRA that I hold 2 stocks in. And then everybody in here probably can guess like what those stocks are because I've talked about it so often. And then the rest for me is in my self-directed environment. Now, we didn't touch on is there anything that you cannot invest in through a self-directed IRA?
Yes. You want me to take that, Brennan?
Sure, go ahead. You talk about the prohibited, and I'll talk about the transactions. You talk about the investment. Yeah, okay. You talk about the investments. I'll talk about the people and transactions.
So it's mainly collectibles, jewels you can't do, life insurance you can't do inside an IRA. So if you wanted to buy bottles of whiskey, some rare bottles of whiskey or wine or whatever your vice is, and buy them in your IRA, you can't do that. You can buy shares of a distillery, right? If you wanted to buy some Jack Daniel's shares, you can do that, but you couldn't buy a rare Jack Daniel's whiskey in your IRA and house it. Definitely jewels, diamonds, things like that you can't do.
Yeah, like a classic car. So you could invest in a mechanic shop, but you cannot buy like the 789 Camaro, because what does the IRS think you're going to do with it? You're obviously going to go drive that around. They do not trust you to not, if you bought 5 amazing classic cars in an IRA, which now is an investment strategy, there's some platform that's doing that, which is really cool. Like, we want to encourage that. It's just not in an IRA. It's not the best place for it. And so other than those prohibited investments, the more common thing that people run into is prohibited people or disqualified persons. So whenever you sign up for a brokerage account, you have to check this question. Like, do you or does any of your close family own 10% of some big public company? And for almost every American, that's like a no. They're not like related to a CEO of a giant Fortune 500. But you do have relatives that run businesses. Maybe you work with your spouse on a business. If you're doing an investment in a self-directed IRA, you have to make sure you don't kind of cross wires with a couple people. Your spouse, your kids, your grandparents, and also your personal finances. So you are technically like a disqualified person when you invest with your IRA. So some people are like, I got a great small business. I love it. It's doing really well. We're doing a fundraise. I'm the CEO, and I'm going to throw in some money in my own IRA. You should not do that. And the reason why is if the IRS sees that you invested with a prohibited person, like your spouse or yourself, you could get your entire IRA invalidated. And that's a really brutal transaction. It's kind of like death penalty for an IRA. And it's so brutal that it's, just trying to encourage people, like, do not mess with these things. So if you ever have a question about that, you can always call our sales line. I would say the most common one is, I would want to buy my parents' property in a self-directed IRA. My parents are moving out, they're going downsizing. They have a beautiful home. I want to rent it out and I want to put it in an IRA tax-free. Can't do it because your parents own that property. You'd be selling between your IRA and a disqualified person or family member. Some other ones are, I'm a CEO of a company, I want to invest in it. I sit on the board and I have a lot of control of a company. If you own over 10% or 50% of a company, you should probably call us before investing. We can give you a little temperature check. If you own over 50%, you should probably never invest. Always red light. If you own 49% to 10% of a company, it's like a yellow light. You can call us and check, and we could probably refer you to a lawyer. If you own less than 10% of a company and you're not like a C-suite employee, you are generally good to go. Always a green light. And that's a really easy way to kind of talk about the prohibited transaction rules. And again, is don't get intimidated by these. We have investors that have, they were intimidated when they're doing their first investment. Stick to a passive investment for your first self-directed IRA investment. It is so much easier. Once you learn these rules really well, then you can jump into some of the more complex stuff and really powerful self-directed IRA investments.
No,
Right.
that's awesome. Yeah, because a lot of our audience, at the beginning of this calendar year, there was a lot of conversation around, prohibited transactions and checkbook LLCs and the decision that came down with McNulty versus Commissioner. And a lot of people really got scared. They were like terrified. They were like, oh my gosh, you cannot do passive investments. And we're like, no. You talk to your custodian.
And the big thing, I think, it's good talking about, so a prohibited transaction rule. There was a big case that came out, McNulty, that everyone was, Whitney is saying a lot of people were scared of. And what the woman violated, unfortunately, is she did something in precious metals that has been a prohibited transaction for a long time, like over 20 years. And it's been clear in the law for a long, long time. And she got caught and their lawyer panicked and they basically said, all right, how are we going to get Mrs. McNulty out of this? Because she broke a very clear law. What's our only way we can try and argue our way out of this box? And they tried to say, oh, because she has a checkbook IRA, she can still, do the prohibited transaction with the precious metals. And the IRS went, no, it doesn't matter if you have a direct custody IRA or what we service in a checkbook IRA. You still can't commit a prohibited transaction. And checkbook and direct custody, these are types of IRAs you could buy at Rocket Dollar. You don't need to. We can get into that a little bit, but long story short is the prohibited transaction rules are serious. If someone calls us and is kind of flippantly, oh, I think I could just break this one, we're either going to give them a very serious telling, or we're going to say, hey, we don't think it's best that we open your account. Like, we feel so strongly about this. We don't think you should open an account here because we don't want you to have a really strong, bad experience down the line. And if someone does have more of a gray area situation, there are plenty of good investments that fall like a little bit in a gray area. Like, you are closely related to someone, and if they own 40% of a company, that's where we recommend a lawyer that we can do for outside counsel. And we've had some clients go talk to that lawyer, and sometimes they say, hey, I really think you can still do this one. And then sometimes, the lawyer talks to that situation and says, no way, Jose, this is bad news. No matter how many ways you cut it, I really recommend you stay out of this investment. And if you're doing a really big investment, that's where you need to bring some of that counsel in, because you don't want to lose if you have $1 million IRA, you do not want to lose that IRA. If you're doing a small investment, you can call us and we can give you a general telling of the rules. We'll probably be able to just tell you the rules on most basic situations. Bring that lawyer in for the really big guns, for the really big stuff.
Mm-hmm. Well, guys, this has been an amazing conversation, and we've gone a little bit over time. And I mean, we'll definitely have you guys back on to talk about solo 401ks, because I know there are several investors here that are like, I want to figure out how to set up my own solo 401k, maybe sidestep UBIT, but really just take advantage of their business helping them grow their wealth. But that said, I want to give you guys an opportunity to, for those people who are listening here live, as well as on our recorded podcast and YouTube show, what is the best way for an investor to get started?
Really, the only way is to go to rocketdollar.com, and then there's a button that you click in the top right corner. It says sign up now. The entire process takes, I want to say, less than 5 minutes, but our CTO is adamant that it takes around 3 minutes to do it. I mean, 5 and 3. It's really a short, simple process to get it going. It does take a while to get the account set up. If you're doing an IRA with an LLC, the direct custody is going to happen a little bit faster. But I would definitely recommend, if you have any questions at all, give us a call. I know it's sales, right? But we're not trying to sell you on Rocket Dollar. We're trying to help you through making decisions, right? So if it's a specific type of investment that you want to do, we can tell you, okay, you might want to look into this one because this will hit your needs, right? We get a lot of questions about silver versus gold. As you can see, the pricing's up there. Silver and gold offer the same functionality. So if you want to make an investment, you can do the same investment with silver or gold. It's really just a service level, right? So if you get the premium product, then you're going to get expedited turnaround times and direct access to our support team.
Great.
Awesome.
Yeah,
And I hope you guys can share with me that link, and we can definitely post it along with the YouTube posting so people have access to that.
We also will have a $50 discount code, and that can give you $50 off the upfront of the silver or the gold account. We'll make sure to include that in the show notes after today.
Absolutely. Absolutely. Well, Nick, Brandon, thank you so much for joining us live. I'm going to make sure we leave plenty of time for those people who are here live to do the rapid fire questions in our after party. And thank you guys in the audience. As always, you've invested your #1 most valuable resource, which is your time, spending it here with us, but more importantly, deepening your knowledge about investments and how you can grow your wealth. Be sure to check out passiveinvesting.com and passiveinvestingwithwhitney.com for future masterclass sessions and to check out our open deals.